Okay, good morning, everybody. In the last few lectures, we were discussing about the cost of capital. We discussed with respect to cost of debts, cost of preference, and we were discussing about cost of equity. We also discussed that cost of equity can be calculated with the help of four methods. Dividend yield method, that we discussed in the last lecture. Second method will be dividend growth model, which we will discuss in today's lecture itself. The other two methods we will take up in the next coming video itself. Dividend growth model, basically we are trying to say that the amount of dividend is going to grow every year on a basis of certain percentage. This method can also be called as dividend growth model, or else we can say a normal growth model, or else we can say as supernormal growth model. Means sometimes it happens that on the basis of the performance of the company, when an equity share is launched in the market, the company may have a good amount of profit. And if the good amount of profit the company is having, the dividend amount can have also a good hike, which we can say as a supernormal growth. And later on, the company can have the normal growth. In today's lecture, we will discuss about the constant dividend yield itself, or we can say that how to calculate the cost of equity if there is growth in the dividend itself. That we can do with the help of few numericals also. So today we will discuss how to calculate the cost of equity with the help of second method, that is dividend growth model. Dividend growth model, which can also be called as normal growth, and later on, if the dividend is growing like anything higher, we can call it as supernormal growth. As we have discussed in the last lecture, that the amount of dividend is not fixed in case of equity shares. That is why the calculation may be bit difficult. As the cost of the equity is dependent upon the amount or the rate of return the equity shareholders are getting, and this return is not fixed, that is why we have to consider few models for calculating the cost of equity. In the first model, we considered that when no growth is there in the amount of dividend, that was dividend yield method, that is the dividend divided by the current market price of the share, which is a net proceed. Today we will try to take up another model where we will assume that the amount of dividend is growing. At what rate? At a normal growth and at a supernormal growth. As you are also aware that dividend, all the shareholders, they expect that their amount of dividend to grow in future years. That means every year the growth rate has to be increased. That shows the benefit in the hand of equity shares. What I am trying to say, that normally equity share will expect the dividend to grow over the number of years. This model, which is dividend growth model, consider an allowance for growth of dividend in future, which is added to the current dividend yield. That means whatever the amount of current dividend yield that we are having, in that we add up the growth rate for calculating the amount of dividend for the next financial year or future year itself. And every year the growth rate will be added to the current dividend rate just to get the future amount of dividend. Dividend may grow, means we can say or like whatever I have said just now, you can note down also in this form. That normally all the shareholders, they expect their amount of dividend to grow, and whatever the rate of growth is, that has to be added in the current dividend yield to get the future amount of dividend itself. Now, dividend may grow at constant rate. Dividend may grow at constant rate, which can also be called as the normal growth. Suppose G has been considered as the percentage of growth. In such cases, we can write the equation in this form. We can write the equation in this form. Right. Dividend may grow at constant rate, also called as normal growth. Suppose G percentage has been taken as a growth rate. And for the number of years, we can write dividend for nth year. See, the current rate of dividend is D0 or DO. We add up the growth rate for the nth year and we are able to get the nth year dividend rate. That means for the present market price, means we can write in this form. The present market price of the share can be shown as the present market price of the share can be shown as P0. You are aware that is a issue price, we can say, or you can say as the present market price. D0 in the current year, 1 plus G in the first year, divided by 1 plus KE, that means to get the present value, plus D0, 1 plus G in the second year, and this will go till the infinity. That means nth year, that you can say. In this way, we are able to calculate the current market price. Now, this equation can also be redefined and can be written in this form. P0 is equal to D0 or DO 1 plus G upon KE minus G, which can be reformed and we can write as D1, that is dividend in the next financial year, upon KE minus G. Because when we add the growth in the current, we get D1. So P0 is equal to D1 upon KE minus G, which can be restructured, and we can calculate the KE is equal to D1 upon P0 plus G. So this will be considered as the main equation for calculating the cost of equity if the normal growth is there, or else we can say the constant growth is there, then this equation can be considered. We can write all the things in one go itself in this form. KE is equal to D1 upon P0 plus G. K is the cost of equity capital that we are supposed to calculate. D1 is the annual dividend per share. P0 is the current market price or net proceed, as we have discussed earlier also. And G is the growth rate, which can be expected to grow at constant, or which can also be called as the normal growth itself. Now, we try to take up a numerical, a small numerical, which will help us in understanding the calculation in a better way. See, this is the, what it says. It says B Limited has equity shares of rupees 10 each, whose market price is rupees 64 per share. Market price is given. A constant, a normal, that you can say normal annual growth of 6% and dividend of rupees 4.6 per share have to be paid by the company for the current year. That means the current year dividend of rupees 4.6 is given. 64 is the market price and the growth rate has been given as 6%. Simple. The equation just now that we have discussed, that equation we can apply. KE is equal to D1 upon P0 plus G. D1 is given as 4.6 upon 64 plus the growth rate, that is 6%. And if you solve, it will come to as 13.19. The simple equation that we can say. Another for practice we can take the second type itself. Some application of mind can be there. X Limited has its shares of rupees 10 each quoted in the stock market. The current market price is given as rupees 20. This information is clear. The gross dividend per share over the last 4 years, पिछले 4 साल की information दी गई है dividend की. That means 1.20, next year 1.32, next year 1.45, and next year 1.60. Means first year, second year, third year, and fourth year. Calculate the cost of the equity. That means last 4-year dividend information has been given. That means if you try to calculate the growth rate, from first year to second year, this can be the growth rate from first year to second year, that is 1.1, and from second year to third year, again it is coming as 1.1, and from third year to fourth year, again it is coming as 1.1. That means we can say that the growth rate is 10%. That is, it is constantly growing at the rate of 10%. That means the normal growth rate of the dividend each year is 10%. That means in near future, because we have to calculate the cost of equity, cost of equity, and this information has been provided for the past 4 years. That means 5th year we have to calculate. And 5th year equation says that D1 upon P0 plus G. So D1 is what? D0 plus the growth rate, we can say. The growth amount, the rate of dividend. Earlier it was 1.6. That means in the 4th year, the amount of dividend was 1.6, which has increased to 10%. Which has increased to 10%. That means we can say 1.76 is the expected dividend in the next year or coming year, that you can say. So D1 comes to as 1.76. Current market price is given as 20, and the growth rate, just now we have seen, it was 10%. All the information has been given. We can easily calculate the cost of equity, which comes to as 18.80%. 1.76 divided by 20 plus the growth rate is given as 10%. That means the cost of equity, if it is growing at normal growth, that is constant growth, it will come to as 18.80%. So in this way, we can say that we have made an effort to calculate the cost of equity when the dividend is growing at a constant rate, or we can say dividend growth model is there. Dividend growth model is there, which is normal growth. The concept of normal growth, the constant growth we have seen. Now, one more thing I have written, that is supernormal growth. Supernormal means that initially when the equity share is being launched in the market, due to reputation of the company, or else we can say due to some good information about the performance of the company, the price of the share may shoot up. That is supernormal growth. And after certain number of years or weeks or period or months, there will be a normal growth. That means if the branded company or blue chip company, they have launched any share in the market, initially we have seen that the growth will be supernormal. And after a few months or few years, there will be a normal growth itself. Suppose this is the equation that I am trying to take up. What you can see here. What you can see here, P0 is the current market price. What I am saying, for first 5 years, it is growing at a growth rate of this. Suppose we can say as 4%. Then from 6th year to 10th year, it is growing at the rate of 6%. It has increased, we can say as G2. And from 11th year, or we can say from 11th year to indefinite period, it is growing at a constant rate of 3%. That means here for 5 years, a growth has been seen. Again, more growth has been seen. And after 10 years, it is growing at a normal rate itself to the infinite period. So this equation, D0 is the current market price, growth rate, first year, which can go till 5th year. From 10th year, or we can say from 6th year to 10th year, this summation can be considered. And from 11th year forever till the shares survive in the market, this equation can be considered. Now, again, we can pinpoint the information in a more clear aspect. In a more clear aspect. In a more clear aspect. Right, you see. Here I am trying to take up about the supernormal growth. Supernormal, then normal. Dividend in the 0 year, it is goes till the nth year, first year till nth year. First year, increased growth rate, which will go to the tth year. Divide this by KE to get the present value, plus dividend in the, or we can say share price in the nth year, and discount the value. This PN, and here the growth is supernormal. Here the growth is supernormal. Now PN is the discounted value of dividend stream beginning in the year N1 and growing at a constant perpetual rate GN at the end of the year N. Then therefore it can be equal to, see the value, how we can write PN. PN can be written as dividend N plus 1. That means जब supernormal growth end होती है तो supernormal growth के ऊपर जो normal growth लगेगी वो, that is N plus 1, and divide by KE minus growth normally. Here is GS, supernormal growth, and here we have GN, that is normal growth. And when we put the value of PN in equation number 1, this is equation number 1 and this is equation number 2. And when we insert the value of equation 2 into the equation number 1, then this equation can be derived. That this is your first information. This is a picture form I have taken from the book itself. The first information from the equation number 1, PN we have opened and divide by, for discounting itself, we are able to get. For practice, what you can do, that you can do a numerical for practice itself. And in that numerical, the same method, the trial and error method, has been adapted. And you can see how you can get the value of cost of equity when a equity grows at a supernormal rate and then at a constant normal growth. Like in this numerical, that company share is currently selling for rupees 134. The current price, that is 134, P0. The current dividend is 3.5, that is D0, and are expected to grow at 15% over 6 years. 6 साल तक, 1 से 6 साल तक 15% पे grow करेगा. That means supernormal. And then at the rate of 8% for forever, that means 8% is the normal. 15% is supernormal growth and 8% is the normal growth. And we have to calculate the cost of equity. The same equation, this, the 12th one, this equation has been used, and you can see that 3.50, 1 plus 15, 1 plus or 1.15 to the power 1. You solve this, it will come to as 4.03. Next year, 4.03 multiplied by 1.15 to the power 2, it will come to as 4.63. Third year, 4.63 multiplied by 1.15 to the power 3, you will get 5.33. So first year, second year, third year, fourth year, fifth year, and sixth year. Sixth year, it was going at a supernormal growth. And from sixth year, after 6 years, plus 8.11, now it will grow at normal growth rate, 1.08, the normal rate. Again, you solve this, this upon this. This your equation comes to on left hand side. I have just given you for practice itself. What you have to do, you have to solve the right hand information. You have to solve the right hand information and try to calculate the value of KE with the help of trial and error method and get the right hand side value equal to left hand side, that is 134. The rate of KE at which the right hand information comes to equal to left hand information, that will be the rate, or we can say the cost of equity itself. And when you solve this equation, with the help of trial and error method, where you are aware that you have to equate the left hand side information to the right hand side. That is, we have to bring the right hand information equal to 134. And if you calculate this thing with the help of trial and error, it is coming to as 12% KE. KE, it will be coming to as approximately 12%. You solve this and you can get the reply. And whatever I am saying. So here we have seen just a revision work, that when we are trying to calculate the cost of equity when it is growing at a growth rate, which can be said as the constant growth rate or normal growth rate, and when it grows at a supernormal. This is the growth applied to the current year of dividend. That is, the normal growth has been added. And then the supernormal aspect has to be there. And in that way, again, we can apply the trial and error method and we are able to derive. You solve this, you can get the answer itself. Okay, thank you all of you.